We posted a video on our TikTok channel recently about the floor trader strategy, and we received a lot of responses from traders who would like to know a little bit more about this. So in today's video, we're going to take a look at the floor trader strategy in detail. First of all, the floor trader strategy was developed on the trading floor before trading became digitized. It utilizes a 9 and an 18 exponential moving average and is a trend following strategy. This strategy is for advanced traders because it requires a high level of discipline and a strict objective view on the markets. The basic principle of the floor trader strategy is simple to understand. The entry is always based on price action, and it can be a great way of entering into trending markets. Risk-reward ratios are generally 2-to-1 or greater, but exits are not as strict as entries. This strategy can also be treated as a scalping strategy. So if a specific trader only has a few hours to trade per day, this system can work on lower time frames. And it also does not require other technical analysis tools. And for some of the cons, there are many false signals that we get in sideways markets. Now, we will take a look at this while we look at all the different entries that we can take using the system and how we can actually identify when the market is moving sideways compared to when it's trending. Sometimes price movement occurs very quickly and a retracement is either too late or does not happen at all. This is another con of the strategy. It also can require a lot of screen time if trading it on higher time frames. It requires a lot of advanced price action reading skills to determine valid trends. The strategy becomes completely redundant in unorthodox market conditions as well, for example, around news events. There are 3 different ways that we can enter into the market. With the floor trader system, it's very important to understand price action and how to read whether a market is moving too powerfully or if there is an actual trend in sight. For example, you'll see many times where the price actually moves aggressively in a certain direction with a big candle that represents a pole formation just like this. So in this formation here, we can see that if I zoom out a little bit, according to the price action that we see, we do clear the previous high, and so we are forming a new higher high. But the problem with this type of move right here and why we want to avoid pullbacks like this is because the price actually moves too far away from the moving averages. So the further the price moves away from the moving average, of course, the deeper the pullback needs to be to come back into the moving average zone. As you can see here, the price action is too volatile or too powerful in one direction. And instead of it being a pullback and then a continuation, which sometimes does happen, but more than not, it actually just comes back down and then reverses or sits in a sideways action again. And you can see that happen right here. When we use the floor trader strategy, we need to look for smooth trending environments where the bars are similar in size and are not unordinarily large. As you can see in this one again, we have a very, very large green bar here. And even before that, there's a bit of a wick on this one, but it's a very large green bar. If this was a trend that was split up into maybe this green bar was, instead of one large one like this, maybe 3, what we would see is the moving averages actually move up a lot quicker with the price action itself. But because we've got one very, very big bar, it diverges, or the price just moves far too high above the actual moving averages. And again, the pullback then just means that a lot of the time it's not a continuation. And that's what we need to look for with this strategy. So again, essentially, we're just looking for trending environments. We're looking for a market that's trending smoothly. And here's a good example of something that resembles a good solid trend that we can actually predict as it moves up. We can see that the moving averages are pointing to the top. They've clearly diverged, and we're not seeing unordinary large candles. We're seeing very clear higher highs, and we can actually mark them off as we go up. So we get our first break over here where the moving averages diverge. We get a higher high at this point and then at this point, and it continues going up as the trend continues. You see how we are clearly making higher highs and higher lows. This is the kind of environment where this strategy will thrive. Whereas if we go back and see a situation where something like this is something we want to avoid. Just by looking at the candlestick sizes alone, you can see that a lot of this price action can be avoided because you've got extremely large green candles being printed over here. And I can mark them off. We've got one here, we've got one here, we've got big red candles, big green candles. This is just showing volatility and a lot of confusion in the market. That brings us to the next point, which is avoiding sideways action. So we know that the first thing we can look at is the size of the candlesticks. The second thing that we can look at is to see if the market is making clear higher highs or clear lower lows. And we can also look at the moving averages. Now, because we're using very short-term moving averages, a 9 and an 18, we're going to see them diverge from each other a lot, even in sideways action. So it's not going to be the most reliable way of deciding whether a trend is going to occur or not. And this is where, again, price action experience will come in. You can see if I mark this area off here, we've got sideways action. And even though we have a few opportunities where the moving averages diverge, like in this one and over here too, and here too for shorts. We could even say for this one as well as a long. We want to avoid this because, of course, this is not a trending environment. And so what we'll clearly look at seeing over here is we need to see a higher high or a higher low form before we take an entry. So if I just clean it up a little bit and I mark off the highest high at this little range, we can see it's at that point. And it doesn't have to be specifically on the wick, but it can be somewhere around there. We're just kind of marking off the average. And we can say that if we see that price is trading within the zone, we want to avoid this price action. We want to avoid any entries we get here. But you can see as soon as we do break through that range, we then do get a pullback. And you can see that this pullback is already a very decent entry because we've got small bars moving into the zone. And by the time the zone is actually tested, we have the moving averages still diverged, and then we get an entry. And so that moves us on to actually how we can enter using the system. So for the floor trader system, we have 3 different entry criteria that we can use. Now, before we get into them, I'm just going to give the traders a small little tip that they can use when viewing the charts, and that is to keep their zoom percentage the same throughout. So what I mean by that is instead of zooming in and out of the chart the whole time like this, which changes the perceived angle of the trend, pick one that suits you, and so that all the trends that you look at have a uniform kind of appeal. With that being said, let's take a look at the L1 entry. First of all, the L1 entry has a few criteria that we need to follow. Okay, it needs to be the clear start of a new trend, must be marked by a new high, and the EMAs are diverging. The retracement candles are of similar size and are not choppy at all. In fact, we don't even need to use candlesticks. We can actually use bars with this because we are looking for the size of the bars instead of the candlestick patterns themselves. The pullback is fairly quick after the first impulse move, and it's not too far on in the trend. So if a trend continues for a long time, as you can see in this case over here, we would be avoiding L1 entries anywhere past the first pullback. And the first pullback is at this point here. So if there's no L1 entry at this point, on this first pullback, once we see the moving averages diverge and the smooth trend begin, we would not take any more L1 entries going forth because it would just be too risky. With the L1 entry, the main thing that we're looking for is we're looking for a very quick pullback that touches the 9 exponential moving average. So I know I said that we must not zoom in and out of the charts, but just to give you an example exactly of what we're looking for, I'm going to go right into it and we can see that once we see these bars move up, you can see the trend is already formed. It's very uniform. All of the candles are of similar size and the pullbacks are of similar size too. If I actually make it into bars, we can see that these bars are all pretty much the same size. The first thing we look for is we look for the retracement to touch the 9 exponential moving average. Once we've touched the 9 exponential moving average, we're waiting for the first retracement bar to occur, but we need to see that the continuation bar happen within 1 or 2 candlesticks after the 9 exponential moving average is touched. So we can see that at this point, we touch the 9 exponential moving average, which is the purple line. We get one more bar as well that is within the zone, but then the third bar is a green reversal bar, and you can see it's a clear reversal signal in this trend. It's a bullish engulfer. It takes out the high of both the previous 2 bars, and this gives us a clear signal to take an L1 entry. So from here, what we would do is we would take our long position on the close of that bar. We would place our stop loss just below the low of the most recent swing. And then in terms of targets, we could go for either a 2-to-1, but don't worry about targets right now. We'll look at that a little bit later on in the video. And here is an example using an L1 entry as well. This is a slightly different trend. Of course, all the trends in the markets are going to be different. We just need to learn how to adapt to each one of them. Now, the difference with this one, and the reason we would take this is, even though this impulse move is very strong to the downside, The reason we would take this entry is because as the candlesticks retrace back into the zone, we can see how they get smaller and smaller and smaller. This is a very good sign that the trend is going to continue again from there. So the first bar touches the 9 exponential moving average, which is this green one over here. And within 3 candlesticks, or within 2 candlesticks, we get our red candle, which is our reversal, and we take our entry. So here again, we would take our entry on this red bar at this point. We would sell it short on the close of that red bar, have a very tight stop loss, and then, of course, the risk is very small with a potential high reward. All right, traders, I want to give just one more example of the L1 entry. And again, just keep in mind, the L1 entry is the riskiest of all the entries, but I did want to show it to you just in case. Now, here's an example of us seeing a clear lower low being formed. At this point, we see a clear lower low, we see the moving averages diverge as well, and we see the pullback, even though it's a flat consolidation period, the pullback is of extremely small candles. Now, when the L1 entry is taken, it's generally because we see an extremely powerful trend in one direction. But again, with that being said, we do not want to take L1 entries when we see pole formations. In this example, if we saw a move just like this, but instead of a pullback of smaller candles moving back, if we saw a pullback of large green candles the same size as this red candle over here, pulling right back into the moving averages like that, that would not be an entry for us to take regarding the L1. But because we see it moving sideways and the bars are very small, we simply again just wait for the 9 exponential moving average to be tested. And in this case, the first bar that touches the 9 exponential moving average is actually the reversal bar that we're looking for. So we would take our short position again at the close of it, placing our stop above there. Before we move on to the L2 entry, I want to just show you a quick example of an L1 entry that is a failed setup and something we want to avoid. This is a good example of an L1 entry that we do not want to take. At this point, we see that we clearly get a new trend formation. We get the moving averages to diverge, and the first pullback is actually at this point. Now, the pullback is so shallow that we don't even touch the 9 exponential moving average. So even though it's a small pullback, we do not take this entry over here. Even though at this point we've touched the 9 exponential moving average, we get a perfect bullish engulfer that we could take our long entry on at that point. But the reason we don't take this is because it's the second pullback in the move. So in L1 entries, again, it's only ever the first pullback that we need to take our setup on. With the L2 entry now, we need similar characteristics to be in place as we had with the L1 entry. We still need to see the moving averages diverge, and we still need to see a clear trend with higher highs and higher lows being formed, of course, if the trend is moving upwards, and lower lows with lower highs, of course, if the trend is moving downwards. Now, one of the main differences between the L1 and the L2 entry is that the L1 entry focuses more on extremely strong impulse trends, whereas the L2 can be taken after the first pullback in a move. Anytime we see the first pullback in a move is most likely going to be the highest probability of success. The longer on the trend goes, the more chance, of course, that we're going to see consolidation come and then a potential reversal. So you'll remember with the L1 entry, we needed to see a quick reversal after the EMAs are tested, whereas with the L2 now, we can actually allow the candles to sit within the range or within the EMA zone for some time. Now, if we look at this example over here, this is an L2 signal because we see closes of the candlesticks within the exponential moving averages at this point. But we can actually see that we've had multiple tests and multiple touches on this specific pullback of the 9 moving average or the moving average zone. You can see all the way over here, we've had multiple touches. Now, if this occurred down here, this would not be an L1 entry that we would take, simply because we're not seeing that quick impulse move off of the moving averages. With the L2, we can allow the moving averages to sit sideways even for a while, and we can allow price action to do a small consolidation. And if you can draw some trend lines in this point, you can see that we actually form some sort of small consolidation flag that we then break out of. Now, the next similarity between the two entries is the L2 also looks for the first impulse candle to be taken as our entry. So in this example, again, we see how price action moves sideways and retraces into the moving averages. The candles are of similar size, And our first bullish candle out of this is this green candle over here. We could even say that this is a morning star pattern, and we would take our entry at this point using the L2. Now, traders, with using the L2 entry, it's extremely vital for you to understand that when we take our entry on the entry candle, it needs to be, for this example, because we're in an uptrend, it needs to be a bullish candlestick formation. It needs to be an engulfer, or it needs to be morning star, or a rising three methods. It needs to be a hammer, something like that. If we do not see a formation like that, it's not an entry for us to take. And the reason I make that so clear is because you can see here that there would be multiple times that we could take an entry using the L2 if we ignored the fact that we needed a strong bullish candlestick reversal pattern for us to take our entry. If we took our entry on this candlestick over here, this green one, even though it is giving us an L2 entry signal, the reason we don't take this is because we do not see that bullish engulfer occur. The best way to take this entry would be at this point here. We see the bullish engulfer clearly take out the previous candlestick, which is a spinning top. Now, this is very similar to an L3 entry. And so let's get into what the L3 entry is. Again, with the L3 entry, we need the same criteria as we did for the first two. With the L3, we do not need to see it as the first pullback. And what's really nice about the L3 entry is at this point now, we actually do not need to see a very strong bullish candlestick reversal. And the reason for that is because we see that price will retrace into the 18 exponential moving average and possibly below. In fact, the strongest L3 entry that a trader can find is when we see a close below the 18 exponential moving average and then a break above that candlestick. And I'm talking in terms of examples here using a bullish trend so that we can all be clear on that. Here's an example of an excellent L3 entry where we see price retrace, the bars are of similar size. We have the moving averages diverge, and a lot of the time with the L3 entry, you'll actually see this kind of formation of the moving averages where you see this kind of dip like a roller coaster. This is a perfect example of us taking an L3 entry. And the reason we would take this entry is because the pullback is deep enough to be assured that if this trend is going to continue, most likely this is going to be the low. And if it's not, then we're going to see a reversal from here. And we can clearly see then that uptrend is over. What we do then is once we see a close below the 18 exponential moving average, and this is important, we need to see a close below the 18 exponential moving average for this entry to be valid. We then simply place a buy limit order above the high of that candle. So we're not looking for a candlestick to close or any specific formation. We're just placing a buy limit above that. So here we got this red candle here that closes below the 18 exponential moving average. And from this point, we're just placing our buy stop or buy limit order at the break above that. Now, there is another way that you can trade the L3 entry, and that is once more candlesticks are formed below the moving averages, you can place your buy limit by adjusting it to the high of the previous candle that's formed. So if we see this red candle form, and then we see this kind of hammer doji form at this point, we see that we haven't broken through this candle, so we can actually move the buy above there. The only risk with this is that, of course, we're going to get slightly more failed entries with that. And here's another good example of a good L3 entry that we can take. We see that the price retraces into the moving averages, and the blue EMA, which is our 18, the first candle that closes above it is this green one. So this green candle is going to be looked at as our entry candle. And from here, what we do, we place our sell stop below that. If you want to go for the riskier way of entry into it and give yourself a slightly higher risk reward ratio with a less win rate as well, you can trail your entry as each candle forms. So at this point, if we did that, we would actually be short on the break of this red candle, and we would run it downward that way. And traders, just a quick one here. I want to show you this is an L2 entry because we do not get a close above the 18 exponential moving average, and so thus we are relying on a reversal candlestick pattern to confirm the trend. And here's another example of an L3. We see the long entry on the break of this red candle here. So we would take our long at this point. And one more example for the L3 entry is this really deep pullback. The deeper the pullback in the L3 entry, as long as the 9 exponential moving average remains above the 18, is better for the system. So we see a very strong red candle that dips far below the moving averages, and we would just simply place our buy limit above that, and you can see that you get filled on the next bar. And then one more entry just to finish off the L3 is at this point here in the same trend. We can see that we get our first close at this red bar over here. So we would simply place our buy stop limit right above it, and we would get filled on the next green bar at that point. So traders, that gives us a good idea of what we're looking for between the L1, the L2, and the L3 entry. Now it's completely up to you whether you would like to use all three or you would like to just perfect one. In my personal opinion, trading this system, the L3 entry has been a very useful one to use. I find the L1 entry slightly more difficult to predict. However, if you're in a situation where there's expected news releases in the coming week and there's very heightened volatility, you may not even get that many L3 entries. So the L1 entry would be a good one to fall back on there. What I recommend is trying it out on a demo account or trying it out at the OneUp Trader evaluations and feeling which one works the best for you. It's better for you to perfect just one entry system instead of trying to understand all three of them exactly the same. All right, traders, so let's get to the final part of the video where we're going to talk about ways that we can exit. Now, first of all, this was actually never very clear to me when I first found the floor trader strategy some years ago. The trader that developed the system did so in a time where markets trended a lot more because there were no computers or high frequency trading. So he used to go for a 3-to-1 risk reward ratio, and then sometimes he would allow the trend to just continue. And if you look at the trends back in the days of the floor traders and the pits, I mean, those trends would go on for days and weeks at some points. So I think what we have to do now is we have to develop a new way of taking profits and a new way of exiting out of the system. And maybe you can develop your own way of exiting out using this system once you've perfected the entry side, and then let us know in the comments below if you found something. But my recommendation, or what I would look at, is we could kind of understand that because it's a trending market, we need to see, for example, in the chart that we have right here, we need to see higher highs being formed. And generally, once a higher high is formed, we see the market push a little bit higher through that high, make a new higher high, and then retrace and form a higher low. One way that we could exit is we could set our take profit at a few points or ticks above the higher high. So maybe if we took this entry here at the arrow, if we've got our higher high at this point, we could maybe set our take profits somewhere around there. And then once we've done that, we could trail our stop loss up to break even and then let another one run. Another way we could do it is if we get very comfortable with the entries themselves and say we perfect the L3 entry, we could just go for a simple 2-to-1 risk reward. And once the 1-to-1 is met, trail it up to break even and then leave it at that. Another way to exit would be to just use a very simple trailing stop. Just be wary of using a trailing stop that moves too quickly, because the last thing you want to do is if we taking a long entry at this arrow at this point here on this example, we don't want our trailing stop to trail too aggressively and then we end up selling at a pullback. We don't want to sell on a pullback. If we are planning on just capitalizing on the first impulse move after we get the entry and we're not interested in waiting for an extremely long trend, then our ideal exit is to get out at the next swing high, which is going to be around this line here. We want to get out at a swing high, not at a pullback. And so, traders, with that being said, I just want to make one final note. Again, because markets do not trend like they used to, we should stick to markets that trend more than others. At times of heightened volatility like news releases or at the market open, especially during the US Open, all the entries that we get using the system are going to be completely invalidated. So if you see that, let's say it's a Federal Reserve Open Market Committee meeting happening that day, it's probably a better idea to completely disregard the floor trader system altogether, because at that point markets are going to be behaving completely irrationally, and so all the system entry that we get are going to probably not work out in that case. So understanding news releases, understanding volatility in the markets is very key when using the system. And also, don't throw away your technical analysis tools such as support and resistance and trend lines, because they can also help a lot when you use this system. And that just about does it for the floor trader system. I hope you found it useful. If there are any questions you have or any suggestions you have, let us know in the comments below and we'll be happy to reply to them.